Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be talking about budgeting and planning. Oh, how fun! Budgeting and planning. Well, it's not all that fun. It's a little boring, but I will try to keep this session as interactive as humanly possible. Talk about a couple stories, how it works in real life, because, that's what really counts. You guys want to know, how does this stuff apply to me and my job? How am I ever going to use this? So what I'll do is I'll put all of this into context for you. I'll tell you a couple short stories along the way. So before we jump into today's discussion on budgeting, I want to quickly recap where we are in the classroom and where we're heading. So last week, you all had that awesome thing called a midterm. And so that's fantastic. And you all did it, the midterm, you all completed it. So that's good. That's important. I did report the midterm grades this morning to the university. So the university is aware of your performance in the class so far. Uh, Everyone in this class is currently at a satisfactorily mark. That's good. That all means you're all passing currently, so that's good. Yeah. So that was last week. You had the midterm exam. The midterm exam covered chapters 17 through 21 was on the midterm exam. What we're about to talk about is chapter 22. So that can be found under module 3, week 5. We're going to talk about budgeting, which is both chapters 22 and 23. So they're broken out into two different sections. So first we'll talk about chapter 22, which is master budgeting and planning. And then we'll talk about some more budgeting concepts and things like cost variances. What does all this mean? Why are you telling me about where we are, Dr. B? So we're in week 5, module 3. Next week, we'll cover chapters 24 and 25. And then in 2 weeks from now, we'll cover chapter 26. And then you'll have your final exam. The final exam will cover chapters 22, 23, 24, 25, and 26. So that's only 5 chapters. And on the final exam, being 5 chapters, it's about 4 questions per chapter, thereabouts. It's about 20 questions. True, false, multiple choice. I believe only 3 of those are math-driven questions. So we'll talk more about that in the coming weeks, but I just wanted to kind of preview that a little bit before we get too far along. So for those of you who are keeping score, we are in module 3, week 5 now. You had your your midterm exam last week. We're going to be talking about budgeting throughout these next 2 chapters. So let's go ahead and jump into our conversation on budgeting. And I'll also tell you a couple of stories along the way. So budgeting gives us permission to spend. That's how I like to think about budgeting. It gives you permission to spend. It says, hey, this is what you have available. This is what you can spend it on. That's what budgeting does for us. And it really is kind of like a roadmap into the future when it comes to effectively managing our money. And so I think that's how I think about budgeting. And I also think about budgeting as being kind of like a financial plan for the future. And that financial plan helps me to plan the business in the future. So when we talk about budgeting, we're talking about giving the business permission to spend money on certain things. Okay. For example, if the business has a rent that it pays every month, we'll say the rent is $5,000 a month. If the business has a rent of $5,000 a month, I'm going to budget $5,000 a month for rent, right? Because I know that that's an expense that's coming up, and so therefore I'm going to budget for it. And that's one of the benefits of budgeting is that we are really guiding the business, giving it the permission to spend, saying, hey, this is what you need to spend money on. It helps me to allocate funds, and it really helps me to plan. And so that's one of the benefits of budgeting. It really does provide uh, that plan. Now it helps to focus on the future, right? So here on the screen, we have 6 primary benefits to budgeting. So why is it important? Well, it helps us to coordinate the business activities overall, so we're driven toward a common goal. It helps us to communicate what the plan is throughout the organization. It helps managers and employees to coordinate their efforts. It motivates employees to establish and achieve things like sales goals. It also helps to plan for the future and to control future costs. These are all great benefits, right? You know, in my opinion, planning is probably the most important benefit to budgeting. And the reason why I say that is because having that roadmap for the business, saying, hey, this is where we're going, this is how we're going to get there, so important because I can establish my budget according to my plan. The budget is almost like a set of goals. Hey, I'm going to hit this goal. Hey, I'm going to hit this goal. Here's how I'm going to do it. The budget is kind of like those parameters, those guidelines. That's why I think of a budget as like a roadmap more than anything else. You've probably heard me say this more than once in the past, is that uh, finance, finance is 80% behavioral, 20% book knowledge. Finance is 80% behavioral, 20% book knowledge. Now you might be saying, well, how is finance behavioral? You know, money motivates people, right? That is like the biggest motivator. Um, it's a big reason why people do things is money, right? There's another expression: money is the root to all evil. Uh, there's some truth to that. Uh, money, money is a motivator. People become motivated by money, and there's some good things with that, and there's some bad things with that, right? The good things with money being a motivator is that, in the workplace, is that uh, employees are typically consulted. They help to establish goals. And they're evaluated based on the opportunities, and there's a comparison between the actual and budgeted performance. That's how money motivates us, right? I'm hitting my goals. Okay, I'm hitting my goals. That's motivating. Uh, I'm being benchmarked. My performance is being benchmarked against the budget. Those are positive things. So remember, a budget is kind of like a roadmap, right? And then this roadmap, there's a series of goals, and I'm going to hit those goals. And so I need to measure my performance in attaining those goals by measuring the actual amount and comparing it to the budgeted amount. If I hit my actual amount, in most cases, that's a good thing, especially if it's like expenses. Or if I come in under the budgeted amount, that's also a good thing if we're talking about expenses. For sales, I want to come in over the budget, right? You always want to sell more than what you budgeted to sell. Those are great motivating things. But with money, as you know, there are always going to be some negative effects, some negative outcomes when it comes to budgeting money. Oh my goodness. This first one drives me crazy because I see this all the time in the workplace. Employees might understate the sales and overstate the expenses to allow for a cushion. Oh, that drives me crazy. Now, here's why. I tell you, every time I go to a small business and I'm consulting with them, and I'm looking at their budget, I'm looking at their actual performance, and there's like thousands of dollars difference in their expenses and in their sales. And I go, okay, it says here you budgeted $20,000 for electric for the year. You only came in at $8,000 for the year. You budgeted 20, you came in at 8. Why is that? What caused that to happen? That's always my first question, right? When you see a variance like that, you're going to be like, this is something doesn't look right here. Your budget was 20,000 for the electric for the year. You came in at 8,000. What happened? And then the response is, well, I had to have some cushion. I'm like, an $11,000 cushion? I'm like, here's the problem with that. The problem with doing something like that, having that kind of cushion, is that the funds that you're allocating in the budget are supposed to be used, okay? And if you're not using 11,000 of those dollars, then where is that going, right? It's like you're supposed to budget for every dollar. So if you come under by a lot because you put in a cushion there needs to be some justification for it. So that's why number one, under the negatives, drives me crazy because I see businesses do that all the time. I see managers do that a lot. I see salespeople do that a lot, and there's usually motivation behind that. Like the salespeople, they might understate their goal for sales, right? And then all of a sudden, oh, they blew it out of the water. Oh, they sold so much. Above and beyond what they said they were going to do. It looks great for them, right? Because they look like the rock star salespeople. But the biggest problem with doing that is now all of a sudden it's like you sold 20% more than what you said you were going to sell, and you did that on purpose. You put the benchmark low because you wanted to make yourself look like a rock star. And so when I see stuff like that happen, it demotivates other employees to do their job appropriately and to advance. So that's why understating sales goals is not a wise decision. And having too much cushion in the budget for expenses also not a good decision because ultimately you're not appropriately budgeting every dollar. The second negative effect of budgeting is sometimes there might be too much pressure on salespeople or managers or other employees to make their results, right? It's like, oh, I didn't meet my sales goal, so therefore I might need to do something silly, right, because of the pressure. So what I'm saying is that when people feel pressured, like they're under the gun to meet their goals, that might cause them to do something unethical or illegal or ultimately lead to fraud. And that's oftentimes why fraud happens in certain companies. The third one here is and this one drives me nuts because I see government agencies do this a lot, is employees might purchase unnecessary items to ensure the budget is not reduced next year. I see that in every government agency, and it drives me nuts. Okay? If you work for a government agency, I know you guys do this. Okay? And it drives me nuts. As a taxpayer, it makes me upset. But this third one, employees will purchase unnecessary items so that way they get the same amount of money next year, right? I've seen governments waste so much money on the most ridiculous things just because they want to get the same amount of money next year. That drives me insane. Uh, Government agencies are notorious for doing that. They'll overspend. They're like, oh, I really needed those $5,000 office chairs. Like, what? It's like ridiculous. But they do that kind of stuff all the time because it's in their budget and they won't get the same amount next year if they don't spend up to that amount, at least in their minds anyway. So, yeah, number 3, that one kills me. Uh, Budgeting, as I had said, it's like a roadmap. Okay, it gives the business permission to spend. That's what a budget does, and it is so important that you budget far enough into the future. Okay, in business, oftentimes we have what is called a rolling budget. I'm constantly budgeted out 12 months into the future. What I mean by that is I don't just budget January to December and then wait until the next year to restart the budget. I don't do that. Most businesses don't do that. What businesses do is they have a 12 consecutive months budgeted. What I mean is, right now we're in April 2022. When April 2022 ends, I'm going to have budgeted all the way until May 2023. When May 2022 ends, I would have budgeted out to June 2023. When June 2022 ends, I would have budgeted all the way out to July 2023. What I'm saying is there will always be 12 months ahead of me that has been budgeted. We call it a rolling budget. It's a continuous 12 months. Always 12 months ahead. 12 months ahead. After this month ends, I plan 12 months out. After the next month ends, 12 months out. There's always 12 months in front of you that has been budgeted. Call it a rolling budget. The master budget. This is the budget for the whole company. Okay? I want to break this down in a couple of different ways. First, I want to tell you the story. Okay? You all know that I spent several years working in the hospitality industry. I worked for Radisson Hotels, third largest hotel in New York State, for several years as a financial controller. And in our hotel, we have multiple departments. We have the front office. We have the rooms division. And within the rooms division, we have housekeeping. We have the front desk staff. We have what do you call when they deliver this food to the room? Room service. We have, yeah, that's the rooms division, and then we also, in the office area, we have a sales department. We have accounting. human resources, uh, the general manager's office, and then in the back of the house, we have food and beverage department. Or, yeah, food and beverage department. Within food and beverage, we have banquets, restaurant, um, and in addition, in the back of the house, we also have engineering. So that's a lot of different departments in one hotel, and they all work collectively. Each department has its own budget, and so what I used to do every year, starting in June, is I would start to host monthly meetings with all the department managers, and we would start the budgeting process for the next year. Okay, and so by August, the budget is finalized. And the way it worked is I would go to each department manager and say, hey, I want you to tell me your budget for next year. Here's the amount of money that would be allocated to your department. You tell me the line items you would spend that money on. And I did that for each department. And then a few months later, I'll gather all of those individual department budgets and bring them all together into this thing called a master budget. Okay. And here's how the master budget works. It starts with the sales department. The sales department budgets the number of units, or in my case, rooms, that they plan to sell during that year. Okay? So the sales department would say, hey, here are the number of rooms I'm going to sell, and here are the number of banquets, and here are the number of weddings, etc., that we're going to sell. Okay? That's what the hotel would do. It, on a product, for a product company, manufacturer, the sales department would say, hey, here are the number of units that we expect to sell. Okay? And we'll multiply that by the sales price to get the total sales budgeted amount. What that does, and we always start with sales. We always start with the sales budget. That is the starting point for all budgets, is sales. And the reason why we budget based on sales is because the sales is what's going to drive the expenses. The sales is what's going to drive the cost. Okay? The more I sell, the more cost I'm going to have. That's obvious, right? Remember, it's based off of volume. So the more I sell, the more expenses I have. And so the number of units I expect to sell times the sales price gives me my total sales budget. That will then tell me how many units I need to make in order to meet that sales budget, meet that sales goal. So if I say, hey, I'm going to sell 20,000 units next year, I already have 5,000 units in inventory that I expect at the end of the year. So that means I need to make 15,000 more units. And that 15,000 units I need to make, I have direct materials, direct labor, and factory overhead that I need to use to make those 15,000 units. And so each of those line items, direct materials, direct labor, factory overhead, also need to be budgeted. How many pieces of material I'm going to use, how much those materials cost. That's my total direct materials. For direct labor, how many hours do I have to make these 15,000 units? And what is the hourly rate for those employees? That would be my direct labor. And then factory overhead, it's usually 100% of direct labor times the number of units. That would be my factory overhead amount. So those three things together, you already know, that's what it costs to make a product: direct materials, direct labor, factory overhead. And all of those things together, including the sales budget, I can then start to budget for other things, like how much cash am I going to need, right? Because remember, we're going to get cash coming in from our customers when we start making sales, but I'm also going to have cash going out of the business to purchase materials, pay my employees, pay my bills. So the cash budget is the last budget that we budget for. We also budget for this thing called capital expenditures. The word capital, capital, in accounting means property, plant, and equipment. Simply put, the capital in the business, property, plant, and equipment. So when you hear capital expenditures, think property, plant, and equipment. That's why it's called. And that capital expenditures, that's part of the investing budget. Remember, investing think about your statement of cash flows. You have operating activities, investing activities, and financing activities. Operating activities, that's the day-to-day operations of the business. Investing activities, that's purchase or sale of property, plant, and equipment. And financing activities, taking out loans, issuing stock, etc. So we budget for the purchase or sale of property, plant, and equipment, and we also budget for our cash. And then also selling administrative expenses, which is related to sales. So we budget all of these individual things together. This all makes up what we call the master budget. So I want to show you what that looks like for a manufacturing company. And so we'll go through each of those components of the master budget one at a time. The first and foremost is the sales budget. Sales budget tells me how many units I plan to sell and the price I plan to sell those things at, right? So it's relatively simple. I take the number of units I expect to sell times the estimated sales price. The number of units I expect to sell times the estimated sales price. That gives me my total sales budget. Pretty straightforward. I hope. Yes. Yes, no? Any questions so far? We're doing all right?
Yes, just stay right there. I'm almost finished.
Okay, I got you. The sales budget also helps the business to identify their advertising expense and their capacity. The word capacity means how many units the company can make in a given year. That's capacity. When you're at 100% capacity, that means you can't make no more. You'll be out of room. You don't have enough capacity to make more. That's what the word capacity means. It's the limit. That's how much you can make. It's a limit. The sales budget also helps with economic and market condition changes. If I know it's not going to be a good year for sales, I'm probably going to decide to make less. So these are things we consider in the sales budget process. This is an example of the sales budget in action. We take the budgeted sales, that's the number of units I expect to sell, times the sales price per unit. Gives me the total budgeted sales. And you see from this example, I do it for every month. Okay. In this case, it's October, November, December. I take my units times sales price. We get total budgeted sales. I do that for each month. Okay. The totals representative there, but we can see how this looks. So I do it monthly. In this example, this company makes hockey sticks, and they sell them for $60 a piece. Company expects to sell 1,000 units in October, 800 in November, 1,400 December. So we take the number of units times the sales price, $60, to get the total budgeted sales. We do that for each month. Very straightforward. Sales budget is probably one of the easier budgets. Don't worry, it gets more complex. The production budget is the next budget. And remember, it all started with sales, okay? So I knew how many units I planned to sell for the year. What that does is it tells me the number of units I need to make. Okay? If I said, hey, I'm going to sell 20,000 units, I also plan to end the year with 5,000 units in inventory ending year. Then that tells me simply I need to make 15,000 units. End of the year with 5. If I plan to end the year with 5, and I know I need to have at least 20, that means I need to make 15,000. So here's the formula for it. This is a very straightforward formula that says, hey, these are the number of units that we need to manufacture in order to meet that sales goal that we talked about in the sales budget. So the formula is ending inventory plus sales units. These are both budgeted amounts. Budgeted ending inventory plus budgeted sales units. Remember, the word budgeted means planned. That's part of the plan, yeah? I plan to end the year with this amount of units, plus the sales I expect to sell during the year. So if I plan to end, if I'm going to end the current year with 5,000 units, so 5,000 plus 20,000 minus 5,000 that I'm going to end the year with means I need to make 15,000. So budgeted ending inventory units, 5,000, plus budgeted sales units, 20,000, minus beginning finished goods inventory in units. That's how many units are left in inventory at the end of the previous year, 5,000. Means I need to produce 15,000 units. This part's important, okay? The production budget, meaning the number of units I need to make, doesn't show cost. It's only expressed in units. Okay, it's only expressed in units. And the reason for that is because there are individual budgets for direct materials, direct labor, and factory. Oh, sorry, broke it. Okay, here we go. This is what the production budget looks like. It gets a little confusing from here, so I'm going to try to explain this the best I can. Every month, we budget out our production based off of the expected units to sell for that month. Okay. So remember, the entire master budget starts with the sales budget. Based off the sales budget, I know how many units I expect to sell during that month. And I also have an expectation of about what percentage of that I will actually sell. We call that the ratio of inventory to future sales. So the way it works is we take the sales budget, the number of units I expect to sell for that month, times the ratio of inventory to future sales. In other words, how many I expect to really sell, 90%. Gives me the budgeted ending inventory, the number of units left at the month, for the month. So think of it like, ending inventory. Plus the actual units we expect to sell, the budgeted sales, equals the required units of available production. Now, here's what this means. Okay. Required units of available production. The word available production simply means capacity. What's the business's capacity? Required units of available production. The number of units I need to make. Number of units I need to make. Minus beginning inventory of the month. The reason why it's minus beginning inventory is because I already started the month with those. I don't need to make them. They're already there. So number of units I need to make minus beginning inventory equals the total number of units I need to make for that month. For October, it's 710. Now you see this little red arrow. The red arrow here, yeah, it's connecting the 2 months. We take the budgeted ending inventory from the prior month to become the beginning inventory of the next month. That's what the arrow means. Very simply put, if I end the month of October with 720 units, or plan to end the month of October with 720 units, that of course will be my beginning inventory for November. If I'm going to end it with October, that means it's going to be the beginning for November. Make sense?
Yes.
I didn't
Yes,
lose
sir.
anyone yet, right? James, you good?
Yes, sir.
All right. Okay, good. And then we do that every month. And that's the process of the production budget. Now remember, the production budget only shows the number of units. It does not take into consideration any type of cost. Those costs will be shown in the direct materials, direct labor, and factory overhead budgets. The direct materials budget shows us the amount of materials we need to make to produce the amount of materials we need to purchase in order to produce the number of units from the production budget. So, number one, first step, is identify the amount we need to produce based off of the production budget. That's why, we got to go in order. So we just did the production budget. And according to the production budget for October, we need to produce 710 units. Each hockey stick requires half a pound of material. Okay, half a pound of material. That's about right. These hockey sticks are pretty light. So half a pound of material, wood, is what I need for each hockey stick, half a pound. So if I am producing 710 hockey sticks, and each hockey stick requires half a pound of wood to make, that means I need to purchase, let's see, I need 355 pounds of wood. Next, I'm going to add in the amount of the ending inventory that I desire, 355 pounds. So I want to end the month of October with 335 pounds of wood. So what that means is, if I need 355 and I want to end the month of October with 335, I need a total of 690 pounds of wood for the month of October. Then I'll subtract out the amount of wood I started the month of October with, because obviously I don't need that. I already had it. So we're going to subtract out 178 pounds of wood that we started the month of October with. That means we need to purchase 512 pounds of wood for the month of October. So now that we know how many pounds of wood do we need to purchase, I can then find the cost. The materials price per pound of wood, market price, $20 per pound. I multiply the $20 per pound by the amount I'm purchasing. So 20 times 512 pounds will give me $10,240 worth of wood I need to purchase. Good so far? So it's get a little interesting. Next month, November, I budgeted for 1,340 hockey sticks to make. That's based off of my production budget that we did earlier. Half a pound of wood per hockey stick, which means I need 670 pounds of wood. I add in the desired ending inventory for the month of November, 137.5 pounds, giving me a total wood requirement for the month of November, 907.5 pounds. Minus the beginning inventory for November, 335 pounds of wood, tells me I need to purchase 572.5 pounds of wood for the month of November. $20 times 572.5 pounds gives me $11,450. I do the same thing for December. Okay, so we talked about the production budget, which led us to the materials budget, which also means we need the budget for labor. Because remember, direct materials, direct labor, factory overhead, these are the three things that make a product. So I need a budget for labor. This tells me how much money I need to set aside for my employees that are making these hockey sticks. And I do that for each month. And it's based on the amount of time it takes to make a hockey stick, to figure out the number of hours it's going to take for the month. And I multiply that by the labor rate to get the total cost of labor. So step one, the number of units we expect to make during the month, 710 for October. Step two, multiply the number of units by the amount of time it takes to make a single unit. In this case, it takes 25 minutes to make one hockey stick. So 0.25, 25 minutes. 0.25. You can think of it as a quarter of an hour, I guess. A quarter of an hour, we'll say. 0.25 times 710 units. That means for the month of October, I'm going to use 177 and a half hours to make 710 hockey sticks. So the third step is we take the total direct hours we're going to use during the month, and we multiply that by the hourly rate. So 177.5 hours times $12 per hour gives me a total direct labor cost for the month of October of $2,130. And I follow the same process for every month thereafter. Make sense so far?
Yes.
Yes, Professor.
Excellent, excellent. Thank you very much. Okay, we talked about direct materials. We talked about direct labor. Now you know we got to talk about factory overhead. Because remember, those are the three things that make the total cost of a product. So, factory overhead, in most cases, and we talked about this before, it's usually a rate that is set by the company, okay? And we call it a predetermined factory overhead rate. So there's a couple of factors that we take into consideration with this rate. In this example, the rate's predetermined of $2.50 per hour. It's the variable factory overhead rate. So we take the number of units we expect to produce times the variable factory overhead rate equals the total budgeted variable overhead. Now that's not the whole story, because it's not just variable costs. We also have fixed costs, especially when we're talking about overhead. So we have total variable overhead, 1,775, plus the fixed overhead rate. The fixed overhead rate is usually always going to be the same every month. Because remember, fixed rates don't change over time. The examples would be rent, manager's salaries, supervisor's salaries, office depreciation, building depreciation, etc. Those things don't change month to month. They're always going to be the same for the most part. So we take that total, divide it out by 12, and that gets you your monthly fixed overhead rate. So total fixed overhead divided by 12 will get you your fixed overhead rate per month. In this example, it's $1,500 per month. So we take our total variable overhead plus our fixed overhead for the month equals the total overhead for the month. Variable plus fixed equals total. Everyone understands that, right? Makes sense. Pretty straightforward. Okay. So we talked about direct materials, direct labor, factory overhead, both variable and fixed. So now that we know those three things, we can figure out the total cost per unit, and we can budget for that total cost per unit. So here's how it works. We know that every unit that we produce has three components: direct materials, direct labor, and factory overhead. We also know how to break that out per unit. For direct materials, we had said that we'll use half a pound of wood for each hockey stick. The average pound of wood is $20 per pound. So $20 per pound times half a pound is $10. 0.5 times 20 is 10. Half of 20 is 10. So for every hockey stick we manufacture, it will cost us $10 for direct materials. We also said, based off of our labor budget, it takes about 25 minutes or a quarter of an hour to make one single hockey stick. And our employees earn $12 per hour. So we take 0.25 or a quarter of an hour times $12 per hour. That gives us a direct labor cost of $3 per hockey stick. The overhead had a predetermined overhead rate variable of $2.50 per hockey stick that was given to us. We also had fixed overhead. The fixed overhead per quarter, which is every 3 months, was $4,500. How do we figure that? Well, it's $1,500 per month, right? So you got that means each quarter was $4,500. Divided by the number of units we expected to produce during that quarter gives us $1.50 fixed overhead cost per hockey stick. We add up direct materials, direct labor, and variable and fixed factory overhead to get a total cost per unit of $17 per hockey stick. You'll see how we got there, right? Yes? Maybe? Okay. Yeah. So we add direct materials plus direct labor plus variable overhead plus fixed overhead to get total cost per unit. Let's see. So we know that our total cost per unit is $17 based off that information. Now, since we know that, we could also budget for what we call the cost of goods sold budget. This is also known as a budgeted income statement. So we take the budgeted sales minus the total budgeted cost of goods sold equals the total budgeted gross profit minus the total budgeted cost equals the total budgeted net income. That's what we call budgeted income statement. The budget for cost of goods sold, we take the budgeted sales units, in other words, the amount of units I expect to sell, times the cost per unit, $17, equals the budgeted total cost of goods sold. Remember, the budget is kind of like saying the planned amount, right? Budget is the plan. We can also budget for selling and administrative expenses. Sales expenses are often times tied to the amount of units that you sell. Sometimes you might have employees that are paid on commission, or they might earn some commission in addition to their regular salary or whatever. And so we need to budget for that. So in this example, the sales employees at our hockey stick company, they make 10% off of their total sales in commission. So we would need to budget that. And the way we would do that is we would take the total sales units that are budgeted, number of units I expect to sell throughout the year, times 10%, to get a commission budget, right? Sales budget. And we also have managers that have sales managers that have monthly salaries. So I'll need to plan for that as well. So I'll take the $2,000 a month, which is the manager's salary, times the 12 months to get the salary budget. And I would add that to the commission budget to get the total sales budget. And here's what that would look like. So for the month of October, I expected to sell $60,000 worth of hockey sticks. 10% of that is $6,000. Manager's salary is $2,000. So commissions plus the sales manager's salary, $8,000. And then you do that for each one. That's pretty straightforward. And then, in addition to sales, of course, you have general and administrative expenses. These are things like office salaries, the related manufacturing process, right? General managers, salary, etc. So many different general and administrative expenses. They're related to the sales and manufacturing process. And here's an example. Manager's salary, $54,000 divided by 12 months. And of course, the capital expenditures budget, one of the last ones. This budget, again, when we talk about capital expenditures, we're talking about the purchase or the sale of property, plant, and equipment. So anything that involves the purchase or sale of property, plant, and equipment would end up in the capital expenditures budget. You all might remember that story I told you some time ago about when I was working at the hotel when the chiller broke. That should have been in the capital expenditures budget if we were planning for that to happen down the road. Most companies do have a capital expenditures budget, and oftentimes the way it works is over the years they'll set aside some additional cash reserves for the plan of buying additional equipment or a new building or whatever, right? That's the whole idea behind having that kind of budget. And the last thing we do is budget for cash. It's important that the business budgets for cash because the business will use cash for the day-to-day operations of the business, but also for some financing activities. Now, we take the cash coming in from our customers minus all of our payments to get our cash balance, right? So whatever we start with for the year, plus the cash we expect to receive from our customers, minus the payments we expect to pay to our vendors, equals the preliminary cash balance. If I have enough cash on hand at the end of the year, I can repay some loans, buy some securities, do some investing, right? If I don't have enough cash on hand, I might need to do some short-term borrowing. And this is the general formula for cash budget. Sometimes budgeting for the cash coming into the business is difficult because not all your customers are going to pay you. Okay. I mean, we hope they will, but we also know from when we were talking in Principles of Accounting 1, that's not always the case, you know. Or you might have customers that will pay you in cash, and then you'll have some customers that will pay you on Well, they'll buy it on credit, meaning they'll pay you 30 days late, right? So some customers will pay in cash, other customers will pay uh, on collections. In other words, they'll pay you on accounts receivable. So 30 days later, you're collecting the cash from that customer. Very common, especially in a wholesale type business. So let's show you an example of that for our hockey stick business. So on average, we'll have 40% of our customers will pay us in cash for the sale, and 60% of our customers will purchase on accounts receivable, which means we'll collect that 30 days later. And so this is an example of what that looks like. The month of October, I expect to sell $60,000 worth of hockey sticks. 60% of that will be accounts receivable, meaning I won't be able to collect that cash until next month. So 60,000 minus the 36,000 gives me the remainder 24,000 in cash sales. Plus any accounts receivables that I'm collecting from the prior month sales. In this example, 25,200 was what I sold on accounts receivable in the previous month. So now I'm collecting it because it's 30 days later, right? So I add my cash sales, my accounts receivable from the previous month to equal my total cash receipts. And I do that for each month. Does that make sense, everyone? How that works?
Yes.
Yes, sir.
Awesome. Great. Thank you so much. Very cool. Yes, we know. Keep forgetting that stuff is there. Okay. Let's talk about cash payments for materials, day-to-day operations of the business. Obviously, I need to purchase direct materials from my vendor in order to keep my business running. Okay, so and I typically pay that in cash. Very straightforward transaction. For the month, I pay my vendor, receive my wood, make my hockey sticks. I do that each month. It's very simple. Cash payments for direct materials to be used that month or for the next month, whatever. And we still need to schedule that out, right? You know, you have to plan for those purchases because it'll affect your cash balances. And so in October, if I know I need to buy $10,240 worth of wood, and I'll pay them next month, pay them on accounts payable, then I know I'm going to have to spend that 10,240 cash in November for purchases I made in October. So again, this just goes back to the importance of planning for your cash expenditures and the cash you got coming in from customers. So the simple formula for all of this for the cash budget. Your beginning cash balance. What are you starting the year with? Plus the cash you expect to receive from the sale of goods and services to your customers. Minus the cash you expect to pay based off of your purchases and other expenses. Equals your preliminary cash balance. If it's good, meaning you have enough cash and you have some reserves, you can repay loans, buy securities, etc. And if you don't have enough cash, you might need to borrow a little bit more money. This is just an example of the cash budget and the various things that are within that cash budget. Things like taxes and loan repayments, all that good stuff. And this is a nice visual representation of that cash budget for each month. And then this is a nice visual representation of the cash payments that we would make each month. And of course, if there's enough cash left over, we would want to pay down any debts. And we could also pay dividends if there's enough cash. And of course, if there's any loans outstanding, there's usually a promissory note where it has to be repaid. Yeah, and that kind of shows the progression of those type of payments. And then if you have enough cash and reserves, and this stems from your budget that you did for the capital expenditures budget, we can make a purchase of property, plant, and equipment. And the last thing we do, once we have all of our budgets in place, we do this thing called preparing a budgeted financial statement. The budgeted financial statements are very simple. The income statement, as you know, is sales minus cost of goods sold equals gross profit minus your selling administrative expenses, and then minus your other expenses equals net income. We can budget for all those things based off of all of those budgets that we have already done. And so what that does is it creates what we call a budgeted income statement. I got my sales budget, cost of goods sold budget, my sales administrative expenses budget, and then I can budget for the rest of it. I could do the same thing for the balance sheet. The balance sheet, as you know, shows assets, liabilities, and equity accounts. It shows the balances of them. And I can also budget for those things based on my cash budget. For service companies, it works a little bit differently because in a service company, you're not going to have direct materials. You're not going to have factory overhead, but you will have direct labor. And so this is an example of what the process for a service company. Service company example of those would be an airline, a hotel, a movie company, a entertainment studio, lawn care service, a hair salon, a barber shop, a mechanic, an accountant, a lawyer, a dentist. The list goes on, right? Those are all service companies. They provide services. They don't provide products. So this is an example of what they would go through. It's very similar. They all start with a sales budget. They'll have a direct labor budget, which is based off of their customers, and they'll have cash budget, capital expenditures, selling administrative expenses. So it's very, very similar in nature. You can also budget based off of activities. Activities being the basis of things that we do in business. For example, we have a certain number of inspections. We have a certain number of purchase orders. We have a certain number of labor hours a year. Those are all activities. Those are all bases for activities. And so we can budget based off of that information as well. So to recap the process for a merchandise company. This is like a retailer, your Macy's, your Amazon, your Walmart, your whatever. This is the type of budgeting process that they would follow for their master budget. Again, starts with sales. The difference here is that instead of a production budget or labor, they have purchases. Purchases are the purchase of their merchandise or their inventory. And then they would create the sales, the cash budget based off of the purchases. And of course, capital expenditures, selling administrative expenses are all budgeted from sales. Follows a very similar process. Here's an example of a retailer budget. Sorry, it's a little blurry. I didn't realize that until just now. Works very similar. The formula for a merchandise company, again, somebody who just sells the products. They have ending inventory plus budgeted sales for the period minus beginning merchandise inventory. Gives us the amount of inventory we need to purchase for you. It's very straightforward. And this is an example of a retailer and their budget for making purchases, for purchasing inventory. So next month's budgeted sales times the ratio of inventory to future sales, in this example 90%, plus equals ending budgeting inventory for which will be the beginning inventory for the next month, plus the amount of sales we expect to make during the month, equals the available merchandise minus beginning inventory for the month equals the number of units I need to purchase. See, it's very, very similar in nature. But the process is extremely similar. So we'll try to get it. Okay, almost there. There. Okay, we made it to the end of budgeting for for manufacturing merchandisers, all that good stuff. We went through the budgeting process. We talked about how the master budget works. So the next discussion we'll start off with is also on budgeting, but it's a little bit more straightforward when it comes to types of budgets is what we're going to talk about. So please stand by.